Welcome to this video where I'm making the argument that 10% net profit is the new break-even point. So when we look at our sales of $1 million, we're going to work through an example where $1 million in sales with a 10% net profit generates $100,000 in net profit for us to play around with and make decisions on. But keep in mind that we first have a commitment where we've got to think about our income taxes, because when we are an LLC or an S corporation, which most service companies are one of those types of entities, this is actually considered to be a pass-through entity. And what that means is all of your net profit, the $100,000, it actually passes through to your personal tax return. And so when you look at your profit and loss statement and your balance sheet, you're not going to see anywhere where you're considering your income taxes, because the actual entity does not pay income taxes directly to the IRS or to your state Department of Revenue. And so what we've got to consider is how much of that net profit is getting pushed out to your tax return, your personal tax return, and you've got to have the cash at the personal level to pay those income taxes. So when we're going to go through this example, I'm going to consider 30%, so that way that includes the federal and the state. Next up are our loan payments. Did you know that loan payments are actually made up of two parts? You've got an interest and a principal portion. So interest is actually recorded as an expense on your profit and loss statement. So it's already considered up in your net profit number. But the principal portion of that payment is not considered in your net profit because it is actually reported on your balance sheet as a reduction of that liability. So that principal payment is not considered anywhere so far. So when we're thinking about the cash commitment, we've got to consider that after that net profit number. So in our example, let's assume that we've got a loan balance of $75,000. This could be a line of credit, or maybe you've got 3 car loans that add up to $75,000. The estimated principal portion of the loan would be about $1,100 a month. So over a 12-month period, you're looking at about $13,200. Wow, you notice our cash account, it's going down. But let's think about our cash reserves. It's recommended that business owners maintain a cash reserve of about 3 months of your operating expenses. If your sales are around the $1 million mark and you've got about 30% overhead, then you can easily have a cash reserve balance of about $300,000. And so in our example, let's assume that we've already got money in that account. We just need to replenish it to get it back to our goal. And so we're going to reserve $25,000. It helps us get back to our goal, and everything is taken care of from a cash reserve standpoint. But next up, we need to think about replacing our old assets. So if you've been in business for a while, some of your assets are starting to show some wear and tear. Or maybe they're obsolete and you just cannot use that technology anymore. So when you start to consider, are the repairs of that asset more than if you just decided to go ahead and replace it with something new for your business? So over time, you're going to end up needing to replace those assets. In this example, let's assume that you're just going to replace one of your vehicles. So let's go with $25,000. We're going to keep the math super simple. And that is the amount of money that you need to replace an old asset so you can maintain the same level of revenue for your business. Next up, we need to think about our future growth plans. We need to start funding those. We've got big dreams of what we're going to do with our business next year and in years to come. So we need to go ahead and set aside some cash so that way we can start funding those growth plans. We can start seeing what type of expenses can we add in the future based on our growth plans. And so this can be a very simple number. You can start off low until you get comfortable with that number. So in this example, I'm just going to start off with $2,500. So as you can see, our $100,000 of net profit can easily turn into only $4,300 of real cash that's available, that's free and clear for us to use. Because we not only have to consider what are our income taxes, what are our loan payments, how do we make sure we're ready for an emergency with our cash reserve, but we also need to maintain our current service level with our assets as we replace them, and then also think about the future with our growth plans. All of those numbers are considered when we're trying to boil it down to how much cash do we really have left over. And so when you're looking at this cash balance, this is not the money that's left over to pay your salary. No, 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 no. Your salary should have been paid out of the expenses when you were calculating your net profit. So this is not the money left over for your salary, but it can be the money left over for you to pay yourself an owner distribution as a return on the investment of operating this business over the last year. So yes, it can be an owner distribution, but no, 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 no. It is not money left over to pay your salary. You should have been a higher priority, and it should be considered in your net profit. So as you can see, your business has a whole lot of cash flow needs that are not considered in that net profit calculation. This is why I am making the argument that you need to calculate not only your break-even point from a profit standpoint, but also from your cash flow standpoint. Because when you consider both break-even points, you'll increase the chances of actually having the money when you need it. Let's dive into what would it look like in the same scenario if we only had 6% net profit. So let's go over to that. So when you're looking at the numbers, you can see, oh no, I'm negative. This is not good. Well, of course, we cannot let our cash balance go negative. And so we've got only $60,000 to work with. Our income taxes automatically adjust because it's based on net profit. And then our loan payments, those are locked in place. That is a financial commitment that we possibly made years ago. So the loan payments, they're the same. So we've got to consider, what are we going to adjust when we're thinking about our adjustments for our cash? And so we might be thinking, okay, let's get rid of our growth plans. And we're still negative, so I really need to replace that asset. So I'm going to keep that, but I can probably lower my cash reserves. I'm just going to make that $10,000. Uh-oh, I'm still negative. I've got to get rid of all of it in order to make my cash work. So that's not too bad. I'm able to pay my taxes on time. I'm able to make my loan payments on time, and I still have the cash that I need to replace that old asset. So that's not too bad. But let's look at, what would it look like with 3% net profit? So with our 3% net profit, again, our income taxes went down, loan payments have to stay the same. So we've got a negative $40,000. That's a lot. Got a lot of ground to make up. So I'm going to get rid of my growth plans. Got to get rid of my cash reserve. I am still negative, but I really need to replace that old asset. Well, I guess I'm just going to have to borrow money. I guess I can use some of this money to pay a little bit down, but I'm going to have to borrow the difference. So what happens when you've got such paper thin profit margins? You don't have the cash when you need it. And then you end up having to borrow even more money when you need to replace an old asset or when emergency happens. And you may feel like you solved the problem, your cash flow problem today, but did you really? You will still have this problem next year. If you do not make any changes you're still going to have this problem next year. In fact, it might actually be worse, because if you have to borrow even more money because you're operating on such paper thin profit margins, then you are eventually going to run out of the ability to make the loan payments. And eventually you're going to run out of the ability to borrow more money. So this is the classic sign of being stuck in the busy but broke cycle. You've increased your sales, but for some reason, at the end of the year, you do not have a whole lot more to show for it. You've generated sales, which is a huge accomplishment. You've generated a profitable business, which is a great accomplishment, but the sales are not as profitable as they should be for you to operate a healthy, sustainable company. You actually use 10% as your new break-even point. You're less likely to run out of cash. You'll reduce the need to actually borrow money. You'll eliminate your super thin margins. You'll actually reduce your stress, at least when it comes to money. And you'll truly have a profitable business that generates cash flow that's needed to not only operate, but also plan for emergencies and save for the future. Oh, have I convinced you? Are you on the bandwagon? 10% net profit is the new break even. I'd love to hear your thoughts. So if you please share your feedback with me, and whether it's your opinion or your experience, I'm happy to receive that additional information and see what's worked for you. Thank you so much for watching.